module, we're discussing housing value chains. We talk about two intersecting value chains, the housing delivery value chain and the housing financing value chain. For housing to be produced, it needs to go through a series of steps, or as the metaphor implies, links that together form a chain of activities. So you start by having to secure the land, assembling it, paying for it, and then acquiring rights over it in order to build your development. If the development is for more than one unit, you're likely to have to split out what we call the mother title for the entire property into separate plots of land. This stage is called titling and involves engaging with the deeds registry in the country. From here, you need to make sure that there's bulk infrastructure, so roads, water, sanitation, power, that will support the overall development in which you can then extend to the individual units. After that comes the link in which the housing unit itself is actually built. This is the construction link in the chain, and it involves bringing together the design of the unit, its internal servicing, the building materials, and the labor. It involves the work of professionals, architects, engineers, quantity surveyors, contractors, masons, plumbers, electricians, and so on. Once the housing is built, the developer needs to sell it, either to a landlord or property management company that will offer it for rental, or to an end user or household who will buy it to own. This link is called offtake and involves the sale and transfer of the unit from the developer to the buyer, and then its occupation or its rental. Once the house exists in a built environment, two more links are relevant to the housing delivery value chain. The first of these relates to maintenance and ongoing improvements over time. And then the final link in the chain is the development of the social and economic infrastructure, for example, schools and clinics, shopping centers, and so on. An important part of the metaphor of the housing value chain is that it is only as strong as its weakest link. This is because each link depends upon the others. If there is a blockage in any one of the links, the process can't proceed. For example, in Kenya, as well as in many other countries, accessing title is particularly difficult and is often delayed. Having secured the land, the developer tries to proceed with the construction. But without title, their potential buyers can't access mortgage finance. And without buyers who have mortgage finance, the developer can't access construction finance because the lender is worried that there won't be any offtake. So the developer then opts to finance her development with the buyer deposits. Very many developments are financed in this way, prior to title being secured. Buyers pay an amount upfront on the basis of the building plan, and then they pay progress payments at predefined stages in the development. While this approach does work, it only works for people who do not need finance, so it narrows the scope of potential buyers and the amount of units that a developer can build at any one time. A further consequence is that it transfers the risk of the development failing to the buyer, so fewer buyers are willing to buy housing in this way. The one broken link, titling, negatively impacts on all other links in the chain, slowing down the development and reducing the scale of units that can be delivered. So that's the housing delivery value chain. Let's now talk about the housing financing value chain. We illustrate this vertically above the delivery chain in a way that shows how the two intersect. Each link in the housing delivery chain incurs costs, and so we illustrate this with finance moments. At the land acquisition link, someone must pay to buy the land. At the title and tenure link, the legal process to enable the transfer must be paid for to a land lawyer or conveyancer, as well as whatever fees apply to the deeds registry. At the bulk infrastructure link, someone needs to pay for that. In principle, that should be the municipality, but sometimes it doesn't work that way. For the house construction link, that's where a developer would like to access construction finance. But a lender will only give them a loan for construction on the basis of land title and bulk infrastructure having been sorted out, and also on the condition that the developer has put their own equity into the development. The construction financier would also want to know that there's a way that they'll get paid back, So they want to be sure that there's offtake finance, like mortgages, available for buyers, which is why they want title. At the maintenance and ongoing improvements link in the chain, there would be smaller amounts of finance that would be drawn upon to pay for the process of, let's say, maintaining the lift in a building, or replacing the roof, or building a wall around the property. Finally, we get to social and economic infrastructure, and that would involve investments by the private sector in the development of shopping malls or places of work, or by the public sector in the development of certain social services like schools or clinics. All of these finance moments are served with various finance instruments that are offered by lenders or investors. Municipal financing or developer equity is used to pay for the land. Bulk infrastructure is paid for by municipal financing, or it becomes part of the developer's construction financing process. A construction loan is used to pay for internal infrastructure and the construction of the house. Then the mortgage instrument kicks in to take over the costs incurred by the previous phases, now segmented into the cost of the particular unit at the offtake link. Maintenance and ongoing improvements might be financed by an equity withdrawal on the mortgage, by savings, or by microloans. And then the public and private sector use particular products to finance the social and economic infrastructure. In some cases, there are also subsidies, money that is offered on the supply or the demand side to ease costs and enhance affordability. All of these financial products are offered by the public sector agencies, banks, pension funds, non-bank financial institutions, guarantors, developers, employers, rental housing institutions, and so on. But in order for these institutions to be able to offer the financial products that provide the capital for the finance moments, they need money themselves, or, at the top of the diagram, funding instruments. On the private sector, this includes the capital markets or the National Stock Exchange, institutional investors, the insurance industry, including pension funds and insurance companies, private equity investors, as well as household savings and deposits. On the public sector side, the primary funding instrument is the national tax base, and at the local level, the municipal tax base. The key thing about the diagram is that these two value chains, the housing delivery value chain and the housing financing value chain, they intersect and interact with one another. And taking that metaphor of the chain being as strong as its weakest link further, in the intersection of these two chains with one another, any weak link can undermine the ability of any other link to function effectively. So if there's a problem with house construction, for example, say there have been a spate of buildings collapsing because the construction inspection processes are not working effectively, this might get reported in the newspaper, and an investor reads about it. The investor might have no particular knowledge of the housing industry, but when they see that inspections aren't happening properly, leading to the risk of accidents, they make a mental note not to invest in construction, and to maybe shift their focus to telecommunications or something else. The housing value chains are also linked to the wider economy. So, if a country decides that they want to raise investment capital, say to develop a new port, they increase the rate of interest that they offer on treasury bills. This is because when treasury or T-bills, as they're called, have high interest rates, it attracts investors who are happy to give their money to the T-bill because they can be secure of a predictable return. So when this happens, investors put their money into the T-bills and not into commercial banks that might be offering mortgages or construction finance. The bottom line is that everything is connected, and it all boils down to the housing delivery value chain. When it is not functioning efficiently, and when investors fear that there's more risk than return in putting their money there, it becomes expensive, or it fails to attract the capital it needs in order to proceed. This further undermines its performance, and then, is it any surprise that the majority of housing across Africa is built by households themselves, one by one, without finance? This module explores how these value chains work and how each link is connected to each other link. I hope that by the end of this module, you'll be able to think analytically about your own housing market and where there are broken or weak links and how you might go about fixing them.